Hey, welcome investors to the 40 Finance channel. Today I'm going to share 5 stocks that sort of sit very squarely in my radar. If you watch the channel for a while, you know that I've sort of been unimpressed with the stock market prices that are going on now. The market just feels like it's trying to find its way, and I've been trying to find my way as well. So really just trying to hang on to some money and see if we have a correction or a downturn. We did have a little bit of price action this week. NASDAQ slipped a little bit. I picked up a couple more shares of Zillow in that process. But really, I'm kind of looking for my next larger investment. And when I say larger investment, I'm talking about some of my top holdings like Visa, PayPal, stuff like that. I don't want it to be 100% speculation. I'm looking for growth, and I'm also looking for a track record of success, or at least a potential track record of success. So typically for me, that means plus 10% on the top line, plus 10% on the bottom line, projected for certainly the next year, and really we're kind of hoping for double digits across the next 3 to 5 years. All right, so let's talk about which stocks are on my radar right now. All right, first one on the board is the Trade Desk. And this is a stock that I've been watching it for a long time, and I've watched it have some huge peaks and valleys, particularly during COVID times. And I'll switch to, here's the 5-year chart. So this was definitely a beneficiary of COVID. When you think about the Trade Desk, you're talking about digital advertising across every imaginable channel, right? So whether it's connected TV, display ads, whatever, they are the hub for advertisers to use to go find inventory. And if you follow the channel, you know I have a stake in Magnite, which is a much smaller stock that sort of does the supply side. And Magnite and Trade Desk work together in a lot of ways, including making sort of industry best practices across some of this technology. If you've been following the industry during COVID, you know that connected TV and the additional video services that are out there, including things like YouTube. We know that the fragmentation of video advertising is probably right knocking on the door if it hasn't started already. So I'm very intrigued here. And with Trade Desk, while I missed a huge run-up on it, you can see from May 1st, you're at $31, and then it reached a peak of 90, and this is split adjusted here. Okay, this stock was, a 10x this price, $690, something like that. Then they did a stock split. But if we look back to just maybe, there's October, you're at 56. And depending on what happens with stock market volatility, it wouldn't surprise me to see the Trade Desk maybe dip to 60, maybe below. And if it did, this is definitely one I'm interested in. All right, so does Trade Desk have the credentials I'm looking for? We need a positive EPS, and we need double-digit returns on the top and bottom line, at least projected. And I would say they're getting there. Not 100% sure if this is non-GAAP or GAAP EPS. I haven't looked into it that closely. But either way, you have Yahoo posting a projection of 71 cents a share. So certainly not cheap from a PE ratio when you start to look at this. And this year, their EPS is not growing plus 10%. So you see 69 cents last year, and then if they hit the 71, then that would not be a 10% growth. However, next year's projection is in that range. You figure 10% of 71 is 7 cents, I guess. Projections at 0.82 next year. Then if we go down to the top line in the revenue, this year the projection's about 39% if they get into this $1.17 billion. Next year you're in 28% if the projections hold true. So they definitely qualify. They're also in an industry that I'm interested in, which is digital marketing, and I think it plays very well into the potential consumer discretionary demand we might see if we ever get out of these COVID clouds. All right, on the TipRanks side of things, checking in to see what the best performing analysts think. And we haven't had a trade desk earnings call in a couple months. Obviously, we're getting ready to get into that time period once again. But you've got price targets anywhere from 105, I guess, down to, here's a hold of $60. Now that's from 2 months ago. So that definitely appears to be some upside, at least from an analyst perspective. Now, trade desk for me would be a long-term hold, but I do like to see, I like to buy with some potential upside in the bag, right, to kind of make those first few months while your investment's panning out a little bit easier to stomach. All right, next on the board is Crowdstrike Holdings. This is another one that if you go back to COVID time, has certainly just lifted off. There's your March. Let's get away from March. In May of 2020, you're at 87, and then at 3x from there, always staying ahead of a price that I would buy in terms of valuation. But I think we're going to start to get to this point in the market where some of these sort of more like price to sales, hyper growth stocks, I think that they're going to come down. And if that does happen for Crowdstrike, it won't be because the company isn't doing awesome things. It will just be because the valuation has been very high for this one. They focus on endpoint security. So with endpoint security, you know, everything that you have on your business network has endpoints where people log in, they make changes, databases, etc. That's where Crowdstrike offers top-level security, best in class. I think it's a very important sector, and I also believe that endpoints themselves continue to spread and evolve, right? We have phones now, your car's connected to stuff. There's just so many places that hackers can get into things. I just see it as a growing market. Just waiting, however, for the Crowdstrike price to come into a zone I feel better about, I guess. Here we go on the analyst projections. Let's make sure we have our plus 10%. You know, 27 cents last year, and then 47 cents this year, which is great. It's almost a double up. But you know, when you throw this price into this EPS, you're not going to feel super good from a PE ratio standpoint. Looking ahead to next year, though, they are going to continue growing, plus 10% on the bottom line, actually far above that. And then on the sales side, this is why this stock is so expensive, right? Plus 60% this year. They get into the $1 billion club if they hit this number, and then next year plus 40%. So with Crowdstrike, for me, I'm very, very convicted, but I just think that high valuation growth is going to see some episodes before the end of the year. And I could be wrong, right? It wouldn't surprise me if I am, but if high growth does get chopped hard for a week or two before the end of the year, then I'll be right here ready to buy a stock like Crowdstrike. All right, the third stock here actually has two choices. Put Expedia on the board, but I would say that Airbnb is right there with it, and I haven't yet defined for myself which one I prefer. Okay, so on the Expedia side, you know, you're more or less in the digital marketing portion of travel, right? You don't necessarily own properties. You're just making transaction volume exchanges. And Expedia actually works with the biggest corporations, Disney, Marriott, Hilton, whatever. So I feel like their revenue is probably more predictable than Airbnb, but Airbnb obviously has the potential for explosive growth. Now, while I would kind of lean more towards Expedia, I will say that I'm just a little stumped here that the price of this one is still, you know, $30 over October 19th. Not because they haven't improved and done some things. They've done a lot of infrastructure, digital infrastructure changes. And they've got a model that works. What concerns me, though, is just the COVID cloud that I mentioned earlier. Now, they made gains this year, minus $9 a share, just about. They're up to minus 79 cents is the projection. And then next year, maybe they get into 658. And then that starts to become a fairly reasonable PE ratio if they can continue to grow. So growth next year is easy, just like this year was. Plus 60%, that was easy, right? Because you made, nothing in 2020. But can 37% sustain itself for a long period? That's where I'm really having trouble trying to project on the travel side of things. I think Expedia can grow double digits each year for the next 5 years, but the pace of it has been really hard for me to try and calculate, if you will. Let's take a look at the Airbnb stock. And we know this story. When did this one come out? This came out in December of 2020, premiered at 139. Today you're at 166.90. And on the analysis side, I'm not sure what their profit story is, but they are growing their negative EPS by a substantial portion. And it might be surprising to some of you, I know it was to me, that next year's average estimate is 40 cents. So they could get into the positives next year. They're certainly growing 10% on the bottom line, albeit it's a negative bottom line. And then on the revenue side, this is what has been interesting with Airbnb. So huge growth this year, 68%, takes them up to $5 billion, which is very impressive. But only 25% projected next year at $7 billion. That's good, right? But we are paying a premium for the stock, as I just showed you with the EPS. So is Expedia the better deal from a value standpoint, even though there's a wild card with Airbnb that it could blow up and do substantially bigger, better things than people thought? It's a tough one to call, to be honest, but I know that one of the holes in my portfolio is travel stocks. I want to get one. I've thought about Disney. I keep coming back to more travel pure play, but I'll have to think about it a little bit more. All right, next on the board is SolarEdge Technologies. And you may remember that I had held Enphase Energy, took a decent loss on that one because I basically bought it high and sold it low, but always with the thought process of booking the tax loss and getting back into Enphase. However, as I continue to read more and more and more about the solar industry, there's a side of my brain that keeps chirping SolarEdge to me, not only from a valuation standpoint, where SolarEdge is much, much cheaper than Enphase, but also from a volume standpoint as well. SolarEdge just does more business, quite frankly, than Enphase. Now, what's been interesting about these solar stocks is that they are really about flat over a 12-month period, and a lot of them are in the same. You had the big run-up in COVID. I'll argue that a lot of this run-up was people with too much time on their hands thinking about how solar is going to be, grow much faster than it actually is growing. But I do think the future of the industry is very bright. You had a peak in December of 2020. This one got to 319. Now you're sitting at 265, and it's just been kind of stumbling along this year. If we were to see a market correction or something like that, I want to have a solar play. And right now, SolarEdge is leading the pack. Not throwing Enphase out yet as an option, but the more and more I read, the more I think that this one is more fairly valued than Enphase. So I'll be looking for this, but again, I'd like to see a little bit more upside in the short term. I think supply chain problems could dampen this, as well as the uncertain future of interest rates and how people might be adding solar to their home. So I do like the company for, say, 10 years looking out, but I haven't yet found that opportunity that I feel 100% good about to buy in. All right, stock number 5, I'm just gonna say that is the most ridiculous stock on my list, but I am super intrigued with some of the things that Snap is working on in terms of like virtual reality. It's a little less concrete, I would say, than some of the other companies that I'm looking at, even like SolarEdge, for example, where I think we all know the solar industry grows more than it is today. Virtual reality, specifically as it pertains to Snapchat, I would say has a much bumpier path. But when you look at the company, now that it's growing up a little bit, it's not cheap, but we go from minus 6 cents to 36 cents this year, which is obviously plus double digits, and you get into 80 cents next year if their projections hold true. Now, on the revenue side, and I can't even believe what this company is making. When you look at their app, and when you're a little older like me, you don't understand, all the things that make things cool. Plus 67% this year to land over $4 billion. And then next year, a projection of almost 50% revenue growth. So it definitely ticks the boxes. Certainly not from a valuation or expensive standpoint, but you really need to go through some of Snapchat's earnings reports and investors reports, not the 10Ks, okay, the PowerPoint slides or whatever they are, where they talk about how they see virtual reality combining with reality, if you will, and how people in their age demographics would actually prefer to share themselves online in sort of a morphed way of real and virtual. So keep an eye on Snap. No promises on this one. Obviously, at this valuation point, though, if my theory holds true at all, that expensive stocks, a lot of price to sale type stocks do get cut hard on the next correction. I've got my eye on Snap because they really do have some interesting presentations about how they're going to keep their app growing and morphing into new things. All right, last little bonus one I'll throw out here is Lyft. Lyft and Uber both still hold some intrigue for me. There's a side of Lyft, though, that has always intrigued me a little bit more, and that is their Google connection and Google integration. I'm not sure how much that'll pay off in the short term, but if Google with Google Maps does start to get into Waymo and their self-driving, I think Lyft would benefit more in terms of if Google hits it right. I think Lyft would be a better beneficiary than Uber just because of their partnership. However, it's important to know that Google has been investing in ride-hailing apps across the board, so it could just be me. However, on the EPS growth side, you got plenty of growth, though still negative this year, minus 266 last year, about minus 39 cents this year. Next year could get close to $1, 69 cents. So not a horrible PE for a company that is growing as fast as it is. And you see here, what is interesting about Lyft is they have more growth projected next year, albeit a slim margin, 39% versus 36%. That's always a very intriguing stat when I see it. It gets, as companies get bigger, especially when they start from zero, the percentage growth, it typically goes down, right? Because you have to hit more numbers to kind of compound from there. And in Lyft's case, hell, if it's even flat, or plus 1%, very strong for a company to grow at a faster percentage pace next year. All right, guys, so those are 5 stocks plus a bonus pick in there with Lyft that I'm watching right now. I just can't seem to press the buy button. Who knows if I miss an opportunity here. I just haven't seen an event that really, to me, has brought prices down temporarily to get super excited about. But we'll see how things go. We still have another quarter left here in 2021. We'll see how the market reacts. We'll see how the winter of Delta goes, if there's any more scares in the market there, and maybe I'll get lucky. Otherwise, it could just be missed opportunities if I don't buy into these stocks soon. All right, guys, thanks as always for watching. Please hit like, subscribe to the channel, all the things. We'll see you on the next video.